we get started, I want to remind all participants of this lovely disclaimer. The purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. MicroCap Club is not a registered investment advisor. MicroCap Club, its partners, members, subscribers, affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. I want to thank the MicroCap Club community for participating on this business breakdowns conversation with Jason Wild, who is the executive chairman and largest shareholder of TerrAscend. And TerrAscend, it trades on the Toronto Stock Exchange, actually newly trades on the Toronto Stock Exchange under the symbol TSND, and it trades on the OTC markets under the symbol TSNDF. TerrAscend is a vertically integrated North American cannabis company with operations across 5 states, Pennsylvania, New Jersey, Maryland, Michigan, and California. It's one of the fastest growing MSOs in its peer group, which we'll learn about shortly. And the company has put out guidance for around $320 million in sales. It produced free cash flow in the Q3 quarter. And it's a real business. It's a substantial one. It's around a 600 million market cap USD, and really just looking forward to having this conversation with Jason to learn more about TerrAscend and also the cannabis industry. You know, when I think about investing in certain industries, whether it's industries like life sciences or mining or now cannabis, you know, I think it's really a bet on the jockey, and you really have to make sure you're betting on the right person. And so that's why it's an honor to have Jason here with us today. And I look forward to diving a little bit more into his background, what led him to getting involved in TerrAscend. And that's going to be an exciting part of the conversation. But first, I want to thank Jason for joining us today. Thanks, Jason.
Thank you. Thanks for having me. I'm honored to be here with you.
So, you know, we've known each other for several years, but you have a really, really eclectic and unique background. And part of that background is that you were a pharmacist that then started a hedge fund. You know, how exactly did that happen?
Sure. So my roommate had the Peter Lynch books, the famous stock picker. His books were What Up on Wall Street and Beating the Street. That was when I was in pharmacy school. I picked them up, and I was just I loved his Peter Lynch's whole approach. I mean, it was all buy what you know, and that you should have an edge over everybody on Wall Street that just works on Wall Street and is very often directing a lot of the money into these stock picks in a certain sector. But people from that industry should have a real edge over them. So I took that whole approach to heart while I was a pharmacist. I had about $10,000 in the bank that I went and set up a Charles Schwab account with and started picking some different drug stocks. And then got my pharmacy degree, and I had never made any real money. All of a sudden, I was making $65,000 a year in 1997 and only needed like half of that, amazingly, and kept funding my Schwab account and continuing to invest that first year as a pharmacist. And that first year, largely because I used margin, I wasn't smart enough maybe to know that you shouldn't margin everything 2 to 1, and when you had more buying power, go out and buy more stock. But I was young back then, young and naive. But that first year, I turned about $30,000, which is what the count was at the start of the year, to about a little over $450,000. And I look at that compared to what I was originally excited about in terms of my salary as a pharmacist, and I was like, wait, this is a whole lot more lucrative, and more importantly, I enjoyed it so much more, and I felt like I was good at it. Like they don't teach in business school or even in these books that certain people are built to be able to make money in the market, but most people are not, because most people have a problem. They hold on to their losers and they sell their winners. For some reason, I'm wired differently, and I tend to hold my winners or even buy more if they're executing better than I ever thought, and I try to sell my losers, more quickly.
So did you start out of the gate with 35 million under management, or how much money did you start with?
Yes.
For the hedge
yeah.
fund?
Sorry. So yes. So what happened was I realized that I loved it. I wanted to be talking about stocks all the time. The people in the pharmacy didn't want to talk just about stocks 24/7 like I did. And I found an ad on the back of Barron's that said, "Do you want to start your own mutual fund or hedge fund?" It was a gentleman who ran the fund administrator, who we still use to this day. But generally, it was going to, he gave me the sort of the lowdown, and it was going to cost me about $20,000 in legal fees to set up an investment limited partnership. You know, I decided that that was a worthwhile investment. My thought was, if you build it, they will come. I didn't care what I started with. I just cared about getting my track record going, you know, an auditable track record. So launched the fund with 80 grand under management in 1998. Sort of, you know, the rest is history, so to speak. You know, really, I practiced as a pharmacist the first 2 years. I moonlighted at night at the ShopRite Pharmacy in Paramus, New Jersey, just to be able to, you know, help pay my bills and all of that. But really, from 98, starting with 80 grand, by 2010, got up to about 25 million in assets under management. We're up about 22 or so percent per year net of fees. And so it was largely through appreciation, you know, the beauty of how compounding works. And that was, you know, much bigger than I remember in the beginning. I had a friend who said, you know, what could you get this up to? And I was like, man, yeah, I mean, which is like a little silly in retrospect. Man, if I could just get up to like 3 or 4 million, I'll be so psyched. Part of it was I really believed in my ability to compound and, you know, grow the portfolio. I always looked at it as I was running my family office, and anything else that I took along for the ride was sort of gravy.
Yeah. So what was the kind of the big win that put you on the map then during those years?
It wasn't necessarily there weren't any specific names. I definitely gravitated towards what's called the specialty pharmaceutical sector. Those are all the pharma companies that are not big cap pharma like Merck and Pfizer and Abbott. I found them to be more entrepreneurial. They had the ability to go and buy assets, shake loose some assets from some big pharma company where a product could be an orphan there because it's a $20 or $30 million product. But I found these smaller companies could really revitalize those products, put a sales force behind it, do a line extension, which had patent protection, things like that. It also included all the generic drug companies, of which there were a lot more back then than there are now. There's been a lot of consolidation there. But we did really well in those names. But on top of that, you know, I found that I'm a pretty good growth investor, just like regular, you know, consumer products types businesses, consumer electronics. You know, back I remember in 2002 when Apple launched the iPod, we started investing in Apple and on that for several years. And really, it all comes down to back to what I said earlier. I think is like hold your winners, sell your losers. You know, sounds very easy, but we know that it's very difficult, and it's easier said than done, I guess.
So when did you start making more active stakes in private companies? I know a big success of yours was Arbor. You know, maybe tell us the background of where that came about and how that really put you on the map then to be able to do something.
Yeah, absolutely. So that was in 2010. We had gotten the funds up to about $25 million or so. And what happened was in Spec Pharma, I found that I was really good at, if a company came out and announced one morning at, you know, 7 a.m, we're buying product XYZ from Merck for this amount. I realized I was pretty good just through the experience I had over the years of, you know, on the back of an envelope or on the back of a napkin, I can figure out this is going to be, you know, roughly this, there's going to be roughly this amount of accretion. And, you know, here's the patent protection. I can go look in the FDA Orange Book and see how many patents there were, all of these different, I had a lot of different tools to evaluate a deal. And I ended up betting, you know, right on a lot of the announced deals. But then what happened was around 07, 08, I found a deal from one of the companies I was invested in. They told me they were thinking of maybe getting out of their generic business. And I ended up introducing them to another company I was invested in, put this deal together. And this company who got the deal was probably one of the best deals I've seen. They paid $10 million for the rights to this first to file generic, had a few things break their way within 6 months of that, settled with the branded company. And over the next 5 years, they did several $100 million at roughly a 90% gross margin. So, you know, happy for that company. I didn't own that much stock that it would have made me so overly happy. And I didn't get paid for it. I got a pat on the back. But often when I do things that are I look at as costly or missed opportunity or whatever it is, I say, how can I do this differently in the future? And how could this be maybe just an expensive lesson? And that's what put in the idea in my head of, I can find products. I know which products, which assets are good. I've got a good network. Companies come to me and see me in my offices because they want me to invest in their company. So I felt like they were more open with me than they would be with an M&A or a BD person at a competing pharmaceutical company. So that would be another way to find more good products. And I felt like that would be the path to being able to monetize all of those aspects. I found it took me a little while to find a CEO to partner up with, but found a gentleman named Ed Shutter. Well, I knew him, and at the end of 2009, he agreed to come be the CEO and partner with me on this. And we bought a platform. We bought a company called Arbor to have a platform. They had $1.5 million in sales, like 6 sales reps, products that were nothing special, but they had their licenses in every state. And we bought that business for $2.5 million, put another $3 million on the balance sheet, and just we both set out to. We both had our own networks of finding deals, and we both found deals that first year. And amazingly, the following year, 2011, we had these deals under our belt and had structured them really well, where they required almost us to raise almost no equity. But the next year, we did 127 million in sales and 55 million in pre-tax profits. 3 years later, we're doing 100 million in pre-tax profits, and we ended up selling a third of the company to KKR at a $1.12 billion valuation. It was roughly 155 times what we invested in the company a few years earlier in 2010, and that's what put us on the map. Because my investors, it was great that our performance took off during those years, because we owned half of a company that was now doing $100 million in earnings, pre-tax earnings. Even if you mark that conservatively, it became like 80+% of our portfolio. That's all great, but a lot of my investors, they wanted to see it to believe it in terms of being able to be offered liquidity at that valuation. And that's what we did with the KKR transaction. We went to all of our LPs and said, KKR will buy every share that you'll sell them at 155 times what you paid. Many of them took full advantage of that. Others sold part of it. And we ended up selling about $150 million worth of stock to KKR. That was now sitting in my fund. I'm usually very bullish and never really had more than a few $1 million sitting in cash. Now we had a big slug of cash sitting there. And also the fund had ballooned in size, largely because of Arbor, but because our other investments had done pretty well as well. So I figure we were over $400 or $500 million in AUM with a whole lot of cash. And that actually is when we came across the legal cannabis space, because Canada legalized medical cannabis around 14 or 15.
Yeah, it's so you're cashed up after that big win. You were looking for opportunities. You probably get a call or you see a headline about cannabis being legal in Canada. Well, let's go up there and see what we can invest in or partner with. And what did you just go up there and start buying some stocks up there, or did you buy some private companies? What would that look like?
They were all private at the time. Most of them ended up going on to becoming public, but they were all private. And I went up. My first trip was to a company that ended up being bought by Canopy Growth, which became one of the biggest companies in the space and got billions from Constellation Brands. But that was the first visit. And it was just like super interesting to me. I had never been in a cannabis grow before. And I also didn't know all of the true medical uses that they were going to be detailing doctors on. And it wasn't just, glaucoma, which was always sort of the joke indication that people over the years said that they would use cannabis for. It was bigger indications that apply to bigger, broader, populations of people, like anxiety and sleep and pain and other things like that. So that's when I realized this is really medicine. And I also felt this was right around the time that Valiant Pharmaceuticals and a few other companies were getting in trouble for some of these insane price increases that they were putting through. And it was around, leading up to the 2016 elections, and it was getting a lot of attention. So I felt like my view was regular pharmaceuticals, I felt like might finally start to see some increasing pressure from a pricing perspective. But I considered cannabis to be a pharmaceutical. It was just sort of a subsector of pharma that I felt like would grow significantly in demand and in sales over the next 20 years, relative to the rest of pharma.
Yeah, and so you're investing in some of the Canadian assets, and then I know you made a pivot down to looking
Yes.
at in the United States, and so when you made that pivot, like, did you try to just liquidate all Canadian holdings, or like what did that process look like? And then obviously you got involved with TerrAscend.
Sure. So yeah, we didn't actually pivot into the US until after I got involved in TerrAscend. What happened was visited that first company that I mentioned. Then I was so excited about it. I said, I need to start coming back here like every month. I started in out west in BC and work my way to Toronto over the course of 5 days and meet with a lot of different private companies. And we ended up investing mainly in 5 companies. And it was roughly, relative to my portfolio, we invested about 25 or $30 million US. And it was like, say 5-6-ish% position in my fund amongst these. My view was, if it works, this thing could be a rocket ship. It'll have a real impact on my portfolio from a performance perspective. But if they all go to zero, which I didn't expect them to, but if they all went to zero, it would cost us single digits in terms of our returns. And fortunately, it worked out that they all went public, and we bet on the right ones. Like, our biggest investment was that company that got bought by Canopy Growth, and we ended up holding on to that for a while and made multiples of our money on that. The good news also that came along was that Canada legalized rec, or adult use, and that was scheduled for, I think, October of 18. But between these 5 positions in Canada, we were up, sort of multiples on that. It was worth well over $100 million. And then I was up at a conference and I met with all my companies and some other ones. And my last meeting was with the CEO of Canopy Growth, who I was pretty, close with at the time. We were like the 6th largest shareholder based upon that original investment, 6th largest shareholder in the company. And I said to him, man, I just met with all my companies and a bunch of other ones, and something to the effect of, these guys are all the biggest freaking lightweights I've ever met in my life. Which was just, meaning, not for me to sound like a snob, but I'm used to meeting with seasoned, say, pharmaceutical or other public company, US public stock executives. And these executives were not as experienced and came out of different industries. Like, everybody in cannabis, almost everybody's new in cannabis. And if they've been in there for too long, then they're, more comfortable with a whole lot more risk than me and most investors would be. So, like, it ends up being that the only people you can really deal with are the people who have gotten into it in those more recent years. And like I said, they weren't sophisticated. And cannabis brings a diverse, sort of interesting crowd. Certainly, people that are a little bit more comfortable being a little bit more out of the norm. So I said that to Bruce Linton. His eyes, I said to him something like, I think I could do like an Arbor 2.0 here, except in cannabis. And the difference is, we never thought we could be one of the biggest pharmaceutical companies in the world when we started Arbor, when we bought it in 2010, because there were so many entrenched players. But I felt like in cannabis, there really wasn't a whole lot of competition. So Bruce Linton from Canopy loved the idea, and they wanted to be involved. And that ended up manifesting itself a couple of weeks later. TerrAscend, which was a company I'd put 500 grand into in January of 17. It was now November 17. They had a $50 million market cap. They were public. They had no revenue so far. They had a license in Canada. And I was able to convince them to take a $52 million private placement and into the company at $1.10 with a full warrant. So it was essentially, they rightly looked at it as sort of like a change of control in terms of the CEO, and knew what that meant, but was willing to do what was best for the shareholders. And we did that deal. That was November 17. I became the chairman, and we became the largest shareholder. But Canopy Growth, I let them co-invest in it with me. So they did about 40% of the deal. I did 60% of the deal, to show you how much easier things were for the cannabis space back then relative to now from a stock performance perspective. We announced the deal. It's not going to close at $1 or $1.10. We announced the deal, and the next day it opened over $2, closed around $1.80 or $1.90, and then over the next few weeks it went to over $3. And you know what? To be honest, that gave me a little anxiety myself, because with Arbor, we started making a lot of money, and and it was a private company, so we would market as things were getting really, good for us and cash flow and all of that. But here, the company tripled in value, or even more so a little bit, because of we had those warrants, and we hadn't done anything yet, and I was uncomfortable about that.
Well, yeah, I mean, you basically were in a situation where it got unduly, the stock pushed up to levels and you had really next to nothing. It was just all a hype train, and then you were like, oh,
Yes.
crap, I have to backfill this with value somehow. And it's ironically that was what, 6 years ago, and probably today it's kind of the opposite. Where you feel like you have all the assets, it's just not being properly valued.
That's it, and that's the
Yeah.
whole pendulum. I mean, you've been in the market for a long time. I mean, the pendulum swings, right? And but certainly back then, the market was giving companies a lot of credit. I was uncomfortable because I knew. I remember the first day I went up to TerrAscend after we made the big investment, and the employees gathered around. There were probably like 15 or so, and I gave them the whole Warren Buffett line about short term the market is a voting machine, and long term it's a weighing machine, and that's the only way we're all going to get paid is if we build something for the weighing machine, meaning building a real business. And then after those first few months, the stock went up a whole lot. We had competed for some deals in Canada. We were still for those first several years, our focus. We would only invest in Canada because I was honestly worried about getting arrested in New York and doing a perp walk or whatever it was. But the problem was we were competing to make some acquisitions in Canada, and there were these other public companies that were in my view, much less disciplined than us. They would pay a lot more than what we would for an asset, and I felt like there were a lot of deals we were looking at, and I felt like I could get the sellers to sell to us for less than what others were willing to pay because it was all stock. But I couldn't get them to pay 50% less if somebody else was willing to pay double what we were. So we sort of, kissed a lot of frogs and, came close on several deals. But then in May of 2018, I was out in California at a conference, and that was when when the Acreage, which was a U.S. operator, announced that John Boehner was going on their board, and that was it. I was like, I'm not worried. I've got to get arrested. If they're going to arrest somebody, they'll arrest somebody like John Boehner. They're not going to arrest me. But it also fit in with the fact that we were, encountering, some difficulties getting good deals in Canada, and realizing the Canadian market wasn't going to be big enough. I mean, Canada's 10% generally of the size of the U.S. economy in almost every different, industry, and it certainly. In my view, was going to be similar in cannabis. And the U.S., as you know, the U.S. is the best market in practically every industry. Certainly was in cannabis. And now that John Boehner, gave me the all clear sign, so to speak, we decided to pivot into the U.S. And we had been looking at some stuff on the fund side, so I had a little bit of a Rolodex of companies to go start talking to, but that's what made us enter into the U.S. I don't want to preempt too much. I know we wanted to go through the deck a little bit.
Yeah, we can, and we can do that now. We might as well. I mean, it's a good transition point. So let's pull the deck up.
Disclaimer. Okay, so the U.S. cannabis market, as many people I'm sure know, about 50+% of the country is now made up of states that have legalized some form of cannabis, whether it's just medical or medical and adult use. I figure it's somewhere over 50%, and certainly from a population perspective, it's even more so. 53%. And then Ohio is one of the most recent ones, large population. I think Ohio rec starts today, pretty much. So that's a good example of another good market that has legalized. Why don't we skip forward a little bit from this? I can come back to some of the things about a safe banking. Big market. We don't need that slide, but big market. Figure the U.S. this year be about a $34 billion market. That's nothing to sneeze at. I mean, pharma, which is obviously a massive market, is around $350 billion in sales. But the difference is there's a whole lot more companies driving a whole lot more profits, obviously out of pharma than here. and in the US, there's several of these what's called multi-state operators, MSOs. But the opportunity is huge. They don't own a very large percentage of that overall $34 billion. Figure if TerrAscend is in the 300 some odd range for this year, figure we're somewhere a little less than 1% of the legal cannabis market. And as you can see, growing substantially. If you combine the legal market, which is what that 34 billion is, combine that with the illicit market, we're talking about something more like closer to $100 billion US market. So huge opportunity, obviously, there, and something that's still generally the legal market's in its more in its infancy.
Well, and it's interesting too, because we talked before about, I think I asked you last time we talked about, how much of the US cannabis industry is publicly owned, meaning within a public company, versus privately owned in small, not small, but in private businesses. And you made the comment that you thought maybe it was 90% privately owned here in the US still, which kind of surprised me. I don't know why, but I kind of had this belief that kind of like the largest public players kind of dominated kind of the US cannabis industry. And that's not the case at all.
Yeah, I think that's partly been a messaging issue. Like, I agree. In cannabis, there's a lot of people that look at these MSOs and they think they're like big, or they call them big corporate weed or big weed, and they have this reputation as sort of these big companies that are just sort of have the ability to crush everybody else. Well, the fact is, I think that's more of a messaging issue for the industry, because nobody is very dominant. And when I talk to these companies, I can tell you they don't look at themselves as these companies that could just sort of exert their will and get everything that they want. I think it's something more about the consumers as well in cannabis seem to. I love it. I'll look on Twitter and they'll be talking about big cannabis and how they've got no morals and values and all that, but and they don't like them just because they're big. But meanwhile, they're sitting and tweeting from their iPhone, which is from a company that's the biggest in the world, and they don't have any issues with that. But yes, not very dominant. And the fact is, the consumer certainly drives who ends up being successful here and who isn't, because cannabis consumers are very sort of well educated, and every month they're expecting higher quality cannabis. And if any of these companies, and especially including the big ones, if they're not getting better, then they're getting left behind.
Okay. Yep.
So that is our very handsome executive team here. I'm the executive chairman. Brought in Ziad Ghanem. He started as president January of last year. He was at Walgreens for 17 years. He's also a pharmacist like me, and he has been real excellent. I know you and I have talked in the past about how in the cannabis space there have been very few successful transitions of companies from being founder-led to being sort of led by an experienced corporate executive. I think we've been able to demonstrate one of those successful transitions, because Ziad is great. And what happens often is you bring in somebody in from a bigger corporate sort of environment, and they can't keep up. They sort of, it's like they're drinking from a fire hose, or maybe they're not the ones they had a big team in the past who did a lot of the work. And that's not the case in cannabis. You need to be able to roll up your sleeves. And Ziad has been great and has great. He's a great leader. Keith is our CFO. He came from Hershey and Dell, and he's been excellent. And then the rest of the team. A lot of these positions were filled over the last year and a half or so. And I feel like the team is, tighter and sort of the best that it's ever been from a perspective of being of competence and going out and operating well. But that's another issue with the cannabis space, is that all of these companies are relatively new, meaning that most of the teams haven't worked together for more than a year or 2 years. It's sort of like, I'd use the analogy of it's like there are expansion football or baseball teams, which we know are not great that first year or two. But once they start getting in sync, and once sort of the people that are, not meant to be there for long term. Once they get cycled out and bring in new people, the operations get a lot sort of a tighter and more efficient. And I feel like that's where we are. It's taken us 6 years or so to get here, but we got a really, really strong team. Here's our journey. So started in Canada as a Canadian LP. We're the only US operator that started in Canada and pivoted into the US. We also, as you see, there was an investment led by my firm and Canopy Growth. In 2018, we entered into the US, or we decided to enter into the US, and we applied for a license in New Jersey. New Jersey was a competitive limited license state. They were giving out 6 licenses to what turned out to be 160 applicants, and they're scored. And we got either the number 1 or number 2 score, and were awarded a license towards the end of 18. In 19, we acquired our first operating business in the US. We acquired the Apothecarium in California, 5 dispensaries, and a small cultivation facility. The Apothecarium dispensaries, if you talk to people in California, they'll tell you that those were the first of the really nice dispensaries in California. Before that, it was more sort of, I guess, seedy looking places. But this was the kind of place that, people of any age would be comfortable going in there. And they sort of became famous for that. They actually won an Architectural Digest award for being the best designed dispensaries. We also acquired Ilera Healthcare, which was a Pennsylvania operator. They were one of the leading market share operators in PA. And that you'll notice that was over time, we gravitated more towards sort of east of the Mississippi as opposed to west of the Mississippi, because these were newer markets. They were growing much faster, because they were smaller and just less mature. But we felt like those were where the better opportunities were, just from a revenue and even more so a profitability perspective. And Ilera was our first entry into the market. New Jersey, which we won the year before, that didn't operationalize until 2020. In 21, we bought some more dispensaries in PA, so we got ourselves to 6 dispensaries. We had 3 that came with Ilera, bought another 3. But really, our play in PA was wholesale. We owned about 20% of the wholesale market. The market was undersupplied, and we had amongst the largest capacity and did really well there. We also entered into Maryland by buying what we call a paper license. There was a license that was for sale by one of the larger operators. They did an acquisition, and they needed to invest a license. We bought that paper license in Maryland. And what we discussed when we made that announcement was, hey, we usually only want to be vertically integrated and when we enter a state. But we think that Maryland, really the prize for Maryland is going to be rec, or adult use, which we think is coming in a couple of years. And we're okay entering with cultivation first. We already have a warehouse that we have lined up that we're going to buy, and we're going to build a brand new grow, a much larger one that can meet the capacity for rec. And since Maryland has a 4 cap on its dispensaries, meaning you can't own more than 4, we said we're not uncomfortable about being a second mover, because it's not like in some other states where we could have entered and some other operator could have 40% of the market. The most anybody could have had was 4 stores out of roughly 100. And we said, we'll get there by the time rec starts. And as maybe we'll talk about it a little bit, that worked out beautifully. We got in just in time at some of the most attractive prices that I think we've seen across the industry, just like with hours before rec started on just this past July 1st.
When you were entering states, like, I know, again, I'm a newbie when it comes to cannabis, but I do know that some of these states are limited license, some of them are unlimited license. What types of, was it these states in particular, and the structure, the legal nature, the limited license part of it that attracted you in, or was it the assets that were able to be acquired, kind of what attracted you into these particular states?
I would say it's a combination of all of it. I mean, we definitely know which states we like better than other states. The obvious things are sort of, is it a medical state? Is rec coming soon? Because usually, rec doubles or triples or quadruples sort of the size of the market. We were certainly more attracted to that than to entering states like, say, Massachusetts. People have been asking us for a couple of years if we want to enter Mass, but like Massachusetts is already rec, so like it doesn't have another huge sort of increase in sales coming along, and those are the things that we have generally sort of have factored into keeping us out of certain places. Also, we've had this is what differentiates us, I think, from many of the other operators, is that we felt that we had the best chance of being successful in any given market if we weren't spread too thin. And some of these other operators are in 15, 20 states. We really looked at, if we're going to enter a state, it's got to be really, clear a high bar because of the fact that because we didn't want to be spread too thin. That's sort of what's been leading us. We always called that we have a deep and not wide strategy. It also helped us dedicate our limited CapEx dollars to building out scale in a smaller number of states, as opposed to sort of being an inch deep and a mile wide. So
you were focusing on states where it sounds like there was a obvious value unlock or catalyst within a 24 to 36 month period of time that substantiated you making an investment into that state, knowing that the market size or opportunity would be expanding rapidly in a pretty short period of time, and then also going deeper into that state made a lot of sense, where again you're not spreading yourself too thin trying to attack 15 things at once. You're going to attack 4 things at once.
Totally. And that's the only way also to drive really good margins, is to have that scale, right?
Mm-hmm.
So I wouldn't say that that was, like I mentioned, there's a bunch of different factors as we're looking at different states, but like Pennsylvania, actually, when we entered there, we didn't say this thing is going to go rec in the next couple of years. There it was, we could buy one of the dominant suppliers in the state, and it's a great medical state. I mean, it was doing, even when we entered, it was doing over $1 billion as a medical state. It also, a lot of it comes down to, population size. Pennsylvania has 13 or so million people. That's one of the bigger states out there. As an example, New Jersey, which is also, attractive, has been great for us. That's got about 9 million people. Maryland's got about 5.5 or 6 million people in population. And then, then that brings in, well, how many dispensaries are there in the state? Is there still room for penetration from that perspective if we're going to be in retail? There's a lot of factors, but certainly rec coming is a big one. And the good news about PA is it still has, rec hasn't come, and it should be coming here in the next year or so, especially since practically every state around them is going rec now. So those are the factors, and also whether it's limited license, how scarce those licenses are. But even that's not the only driver. I think Michigan is a good example for us. We entered Michigan. We love the Gage brand, and we wanted to roll that out in our other states. But within Michigan was an unlimited license state. But there's advantages to that, because these other states with limited licenses, it's great to, Jersey is awesome for us, but we can only own 3 dispensaries. Now we'll be able to own pieces of another 7, but generally 3 dispensaries. Maryland, 4 dispensaries. There's only so much that you can grow the size of your business in a state where you don't have unlimited, the ability to have unlimited dispensary growth. In Michigan, which is certainly a tougher state, but when you get Michigan right, which we now think that we have over the last quarter or so, in Michigan, you get it right, and you can have 150 dispensaries, and that's how you really get the advantage of scale and being able to drive much lower OpEx as a percentage of sales, because you're spreading it out across whatever it is, 100 stores or 50 stores. So each state's got its own sort of aspects. Also, my view is Michigan is like one of the most sophisticated cannabis states. So like you need to show that you can succeed in those more sophisticated markets, because that'll help unlock more of a multiple, in my view, for these states like New Jersey or Maryland, where people say, well, how sustainable is it? And when it gets more competitive, are you going to be able to still be very profitable? If you show that you can do it in some of these states that have not been as such easy going, then people, believe that sort of the machine works, if you know.
Yeah.
If you know what I
Yeah.
mean.
It proves you can play for the major leagues, if you're
Right.
in a competitive market and winning. So
Exactly. So
yeah.
these are, I think I've either touched on or we'll touch on some more of these, but obviously, customers always first, and I think that's the first little part of that slide. In terms of the business, it's got our last quarter up here on the right side. We did $89.2 million in sales. That was up 24% sequentially. A lot of that was driven by Maryland going rec and our new acquisitions there in Maryland, but the rest of the business grew nicely sequentially as well. 35% year over year. I think what I'm even more proud of than the revenue growth was the fact that our operating expenses decreased from Q2 to Q3 at the same time that our revenues went up 24%. I don't mean decrease as a percentage of sales. I mean, they went down by about $1 million. So that obviously flowed through to much better profitability. We did about a 27% EBITDA margin, which is right now back at the sort of the top of the class. But also, a lot of the other companies that sort of hunkered down and sort of driving better profitability margins, they sacrificed a lot of their growth. And here, I feel like we were able to thread the needle really well, drive strong revenue growth, and in addition, drive that better profitability, better gross margins. 53.6% gross margin is right at the top of the industry as well. And that is a massive improvement versus a year ago. I think that number was 37%. So when you get gross margins going from 37 to 53.6, and also operating expenses really nicely contained and controlled, that's how you get to where we put up a $24 million adjusted EBITDA from continuing operations, and we had $9.4 million in cash flow from operations. This is sort of a snapshot of one point in time, in terms of Q3, but it doesn't necessarily tell the whole story of how much progress we've made over the last year and change. What happened is, cannabis was a COVID have. Every industry was either a have or a have not. That first year of COVID, and cannabis was a have because people were sitting at home more often and they had less things to spend money on. Right? There was less going to ball games and concerts and things like that. And the industry experienced a very high rate of growth that first year, and then in the summer or spring of 21. That growth significantly slowed down because people started leaving the house to, they got vaccinated and they started going back to their normal lives. And also they stopped getting stimulus checks right around then as well. So practically every state, the growth slowed down pretty significantly. And that's what sort of threw this industry for a little bit of a loop where, generally the estimates and the stock prices have been going down for about, a little bit over 2 years. We took, I think, pretty decisive action in the spring of last year, where we said we need to right-size this business so that we can get to sustainability. And we looked at sustainability as being cash flow positive. We need to be able to get to sustainability, assuming we don't get any federal reform. Everybody has been very focused on the Safe Banking Act and some other, potential legislative changes, but we really said we need to get this thing right, make the expense reductions, also reduce our interest expense, not just our operating expenses, but this industry is treated pretty unfairly from a tax perspective because the federal government says you owe money, you owe taxes, but the vast majority of your deductions we're going to disallow because you don't have a legitimate business, which is pretty crazy. So cannabis companies pay their federal taxes on their gross profit, not their net profit. Figure on that 53 or so percent gross margins. And between that and these high interest loans, we realized, I mean, it's pretty obvious, but we undertook getting down that interest expense because we were not going to be able to hit that cash flow positivity. You could be EBITDA positive, but that doesn't include the taxes and the interest. And for us and for the vast majority of the industry, even still now, I think for the majority of the industry, after those two big items, those are like the enemy of positive cash flow. We were able to reduce our debt. We convinced Canopy Growth to equitize $90 million of debt, of money that they had lent us. They equitized the debt in December of last year at about $5 Canadian per share, which was, I think, about 100% premium to where the stock was. That was an amazing help and a kickstart towards reducing our interest expense. But we also paid down over the last year or so. We paid down about another $40 or $50 million worth of debt, and it wasn't necessarily because we were like, we need to be less leveraged. It was, we need to pay less interest. And between all of that happening, that's how we've now gotten to that point where we are, where we're cash flow positive. But it was a lot of hard work, and the industry, I would say, you also know how, like, the first time a company misses or industry starts missing numbers, it's almost never one quarter. That's just the way it works. Companies are sort of a little bit caught, on their back foot a little bit, and it takes a little while to adjust. So we went through a few quarters of people not being thrilled with our results. But really, starting about 4 or 5 quarters ago, after taking some major actions, we took 13 million or so out of our expenses. That was obviously very helpful. And starting 5 quarters ago, that was the first quarter we turned to being cash flow positive from operations, and in Q3 of last year. And as I mentioned, just huge improvements in gross profits and EBITDA margins.
What's the outlook for the US changing cannabis as a Schedule 1 to a Schedule 3, or just not a Schedule 1 anymore? Because I think that's the biggest headwind that's keeping the tax situation where it's at, if I'm not mistaken. So what's kind of your thoughts on when that changes, and what could that potential impact mean to you?
Yeah, that would be amazing. And the fact is, we're a lot closer to that than anybody thought even a year ago, because the President Biden last fall made an announcement that he was directing the head of the HHS to reevaluate the rescheduling or descheduling of cannabis. And now we know, because Bloomberg broke a story about 12 weeks ago, that they got their hands on the letter from the HHS to the DEA, which is the proper sort of way that this whole thing flows. They make their recommendations to the DEA, and then the DEA either concurs or does not. But we know that that letter was sent, and we know that they recommended Schedule 3. And Schedule 3 should fix the tax problem, because 280E, where you can't deduct your expenses, that applies only to Schedule 1 and Schedule 2. If that happens, it's huge for the industry. And it would be amazing for us. If we look at next year's revenue, or even like where we're run rating right now, and if those taxes went away, or the deductions were allowed, you've got to figure that TerrAscend would have about an extra $55+ million in either increased cash flow or decreased interest tax tax that's incurred that we would eventually have to pay. That is huge. You know what it's going to do is it should turn many of these companies into companies that actually have PE ratios, where we're not just looking at a multiple of EBITDA, which we know lots of people think is not the most accurate measure of a company's health, but where these companies will actually be considered to have earnings. And I think that should open up a whole new world of investors, because there's lots of purists that won't buy companies that are not GAAP profitable. But even beyond, to me, that's more like the sizzle side, meaning or the voting machine side, meaning like that it's going to attract more because it's going to screen better. The fact is, this will make us and practically every other company in the space just so much more credit worthy all these companies have a significant, and most of them have a significant amount of debt. Ours has been reduced a lot, but we still have some debt. When we go to refinance that debt, we should be paying, several percentage points lower than what we're paying now because of that increased cash flow, where we don't owe the government like almost 10% of our sales. The good news is we've been refinancing our debt at lower rates anyway. We got a loan from a bank in Minnesota back in June at 10 and change percent, which replaced the 12 and 7/8 debt. But that was prior to any of this tax, view that the taxes might be going away. That was just based upon our cash flow getting better. But the whole industry, there's a lot of companies that this will save them. It won't save us, but it will certainly hugely. I just sounded like Donald Trump. Hugely, it will. It'll be a major tailwind to our cash flow and to all those other aspects of the business, like our debt worthiness. Here's the slide. Thank you. I was going to put this up as my background, on for my Zoom here. But we're really proud of this. As I mentioned earlier, growing faster than the rest of the industry. These are the other public operators in the US, and I think that this is testament to our deep and not wide strategy, because we have the ability now. We have so many sort of open states that we can enter and be opportunistic. And that's back to your question earlier about where do you want to be. Part of it is, you want to be opportunistic and get the sort of the best, most attractive terms. And if you don't have to be in a specific state, that's sort of helpful. So this revenue growth will be for this year. We should have some pretty strong revenue growth next year, and hopefully the following year, just based upon our base business, and PA will hopefully be going rec, and we have a very large footprint there. But figure that should also be supplemented by some hopefully very attractive M&A opportunities, and that'll just layer on. It'll be organic growth with some inorganic growth as well.
Can you talk a little bit about that? And maybe there's a slide in particular here too that would be helpful in helping describe it. But you have this interesting scenario where it was kind of boom and now bust, and everyone, and there's been probably a few bankruptcies, but just a lot of businesses doing poorly because they're up against this tax headwind and these high interest rate, because the only people that would lend you money probably back in the day was basically loan sharks, just in a bigger scale.
Yeah.
And so they're up against that, which is why there's such a big difference between EBITDA or adjusted EBITDA and actually free cash flow, is that difference.
Right.
What would you say, what gives you the confidence about kind of this growth rate continuing? Because you can see here the peer group is, outside of Ascend, is growing a lot less than you are. What gives you that confidence that you can kind of continue the double-digit growth trajectory that you seem confident in?
Yeah, I think that it's just our assets in terms of the states that we're in. And it's similar to, real estate. They say every market is local, and that's definitely the case in cannabis as well. And part of why we're growing a lot faster is our selection, and maybe our discipline also, but our selection of states. They were amongst some of the best states. New Jersey, we really focused on building out New Jersey, and we wanted to be one of the top operators. We're number 2 in market share. We think hopefully we'll be number 1. We're up by 0.1% from the number 1 wholesale operator in Jersey. In Maryland is the same sort of playbook as New Jersey, except you can have 4 stores instead of 3. But the amazing thing is, because we sort of hung around the hoop and didn't have too much FOMO in terms of getting those dispensaries, we got what we think are some of the best deals that have been done in the space. I'll give you a quick example of the best store, or the biggest store that we bought. We bought a store in Peninsula in Maryland. It's right near the border of Delaware, and it was doing $13 million as a medical store, which is got to be top 0.25% in the whole country in terms of a medical performance of a medical store. We knew that was going to go up significantly once rec started, and we struck a deal to buy it for $22 million, but we only paid $1.5 million in cash. and then the rest of it was half seller note at 7 and change percent, and half stock. And it was wildly accretive even on the stock that we issued, because figure now that store is doing in the mid 20s in sales, and figure 20-ish% EBITDA margin at the store level. But the other thing, when you look at the pro forma of that business under our ownership versus the previous owners, is we're vertically integrated. We got this brand new large scale high tech grow that we built, and we are now vertically integrating that store, and figure we'll get to about 50%, which is similar to what we have in Jersey. That is what makes the profitability on, say, that $25-26 million in sales. That's what makes it much higher. And if you look at it at a $22 million purchase price, we paid figure less than 2 times EBITDA. And I know EBITDA is not necessarily the most accurate picture because of those taxes and interest, but the margins are so good there that from a cash flow perspective, these assets are significantly cash flowing. That's actually what flipped us to being fully to that cash flow positivity in Q3. And that's what I say. And the way we talked about it is it's the same playbook as New Jersey. And when you have a lot of your own retail, you can grow a pound of flower at say $600-700 and sell it for figure 5,000 plus at retail through your own stores, and it just drives really nice margins. When you look at operators, if they have like a 10-15% EBITDA margin, that's not going to clear the taxes and the interest generally, right? Mm-hmm. But if you have assets that have over 30% EBITDA margins, even on a state level, those things are going to cash flow really nicely. And obviously, we want more of those. We're definitely focused on cash flow. The market overall, like you said earlier, the market is very unforgiving or just doesn't want to give these companies credit for anything. So we got to show that cash flow. Part of it is we got to show it to prove it. Part of it is if the market's going to continue to not appreciate what we've got going, then the cash flow is our answer to continuing to build this business sort of regardless of how the market rewards us. And my view is the market will always, that's the weighing machine thing. Like we got strong cash flow and continue strong cash flow. The stock has to work at some point. And if it doesn't, and especially if the rescheduling happens and say we don't owe those taxes for next year, we'd be very excited about taking a portion of those quarterly savings and putting it towards a buyback for as long as the market doesn't is not recognizing all of that. So that's really Pennsylvania, as I mentioned, that's going to be an amazing rec state. We have 6 stores there and our largest cultivation footprint. When things got when we had that slowdown a few years ago, PA, like most other states, went from can do no wrong to for a few quarters we felt like we could do no right. But we've got that, all straightened out. We are only growing at about 20% of our capacity there because obviously, you can't continue to grow product and pile it up if you're not going to be able to move it all. And that's always challenging. Companies who run into some slowdowns, they need to lower their costs, but then you take a huge amount of capacity offline, which means you need to lower your costs even more. Because you're getting, the opposite of the benefit of scale. And the thing we're proud of there is, Pennsylvania, even at 20% or so of our footprint, we're at a 50-ish% gross margin. And also, the same store sales in that state for practically everybody had been on the decline for the last 2 years. In Q3, when we reported, we had our first up year over year same store sales numbers in our stores are up about 10% year over year in our retail, and we're also I think up about 10% in wholesale. So PA is on the mend, but when rec comes, that's when we can really think. We feel like PA could do about as much business as all of our other states combined once it's running full steam. Upon rec. Should I touch on any of these other ones? California, those were our original assets. We liked being in California. California is sort of the leader from consumer, from a lot of consumer trend perspectives in lots of stuff, not just cannabis, but definitely in cannabis. There was an analyst who initiated us a couple of years ago when we had just California and PA, and the title was West Coast Cool meets East Coast Hustle, which we liked, and we sort of agree with that. And California is it's certainly a more mature market, but we've got that business. It's not hurting us. It makes a small amount of money, and we're working on ways to have it make a lot more money. And then you got Michigan, which I think we discussed.
Yeah, are you seeing a lot of, I mean, getting back to like the industry's sort of been gutted. There's not probably too many players that have a lot of cash or availability, which means there's probably good deals to be had almost everywhere. How do you kind of pick and choose your spots? Like, what's the market environment right now for finding some really great assets like you did in Maryland?
Yeah, I mean, there's other amazing opportunities out there, and the sellers, say, of all these, mom and pops, which just means they're not like the public companies. They are very realistic. They've now lived through what everybody else has lived through for the last 1,000+ days of declines in the public capital markets. They have very realistic expectations, and in our case, at least, we find, and with the Maryland acquisitions, they were happy to take our stock because they saw that it wasn't like they were sort of crystallizing their loss of where maybe they could have sold it 2 or 3 years ago, because they're getting a stock, or a decent component of it is stock in a company that's also absorbed those losses, and they like what we're doing. They also like that we're listed on the Toronto Stock Exchange, and we're the only U.S. operator right now that's listed on a major exchange like the TSX. So definitely, it's more of a sort of the aspect of we need to make sure that we stay disciplined, that we stay opportunistic, and I kept thinking of this line a few months ago from the Revolutionary War when they didn't have enough ammo, and they said, don't shoot till you see the whites of their eyes. We feel like we've been able to really be patient, wait for what we think are the perfect deals, but because we have such a wide open map relative to everybody else, those opportunities are going to be more plentiful for us, because there's a lot more low hanging fruit out there.
I thought we maybe skip to this slide because this is one. It kind of shows just the consistency of growth. You're now kind of free cash flow positive. There's some, hopefully in the next 24 months, some Schedule 1 to Schedule 3 changes that will free up a lot of that EBITDA into free cash flow. And you're obviously expecting growth into 2024 as well. And I think one of the other things that makes you unique is you see quite a bit of insider buying in TerrAscend. I think that's pretty unique in the industry as well.
Yeah, I've definitely been bought, I think, practically the last 4 or 5 quarters or so. And when people ask me about it, I sort of give them the Peter Lynch line about that insiders sell for many reasons. I mean, you and I have been in lots of stocks where we've been disappointed to see some of the executives selling, but they'll tell you it's I'm building a new house, or sending my kid to college, or whatever that is. There's many valid reasons for selling stock, but in the way Peter Lynch laid it out, there's only one reason that insiders buy stock, and that's because they think it's going to appreciate in value and they're going to make money on it. And that's my view. I think that especially because of the execution that we've been able to show over the last year, and not in an easy environment. I mean, many other companies are really struggling at this point. Most of the other companies, I can't think of any other companies that really did much to fix their balance sheets. So that's what's going to, in my view, drive and give us that potential for this continued above average growth, because of the amazing acquisitions that are going to be available to us, and just because our operating business should continue to grow organically, and that we're operating it efficiently. As you can see, we had that 21 to 22. We had that dip in profitability, but we are certainly on the right. We feel like we're on the right track right now. Last quarter was 24 million in EBITDA, so I figure we're run rating already at somewhere close to $100 million EBITDA run rate. And we're thrilled that we are cash flow positive and should sustainably be cash flow positive going forward, even if the taxes do not go away.
Yeah.
So we think they're going to go away. That'll be a bonus. But even if they're not, we've gotten ourselves to that sustainable path, and we're thrilled. And it's different in 2020 into 21. Like, we had a great year, but everybody had a great year. And and not that I'm wishing ill on anybody now, but when people are not doing well, and you're able to really execute and do well, that's sort of gives you a good boost of confidence. Gives me a boost of confidence in our team and our strategy and our footprint and all of that. So we are not going to be at the mercy of whatever the folks in Washington do. Hopefully it all happens. We think there's a better chance than ever. I don't want to spend too much time on this, but there's another pathway towards regulatory relief as well, which is there's been a lawsuit filed against the US Attorney General, and that's sort of the third potential path towards relief. But if none of that comes to bear, then in a few years, there'll be a lot less competitors out there, and even more good deals to be had in terms of building out the business.
Well, I think we're bumping up against an hour. I think we did a pretty good job. The high points. Was there anything else that you thought that you'd like to mention that you think we missed?
I don't think so. I mean, I appreciate you having us on here. You and I as fund managers always have lots of good stuff to talk about. I was thrilled that you wanted to have us on here to present TerrAscend. I do think that we are now, we're sort of like one of the best houses on a bad block. But I say to people lately, like, just look at some, like, if you just look at these metrics or some of the other metrics, look at them and put aside that it's a cannabis company, but look at them as just as growth companies, especially if the taxes go away, because we'll be able to put up actual earnings, and we'll have a PE. But I think from all of my years of looking at stocks, that this is the profile of sort of great growth at a reasonable price type stock names. So
yeah. No, I mean, and I think we could have probably spoken an hour just about stock picking and psychology of investing, all that fun stuff. We could probably do a separate episode just on that. But I appreciate the time. Appreciate you coming on here and telling us more about TerrAscend, about your journey, and also just about the opportunity in cannabis and just understanding it better. So appreciate the time.
Thank you. Thanks, Ian. Thanks for having me.
Thank you.